Hey everyone, how's it going? JDStrategic here. I hope everyone's doing great today. I have my water bottle in hand because we have a long video for you guys. I posted a poll of whether you guys wanted to hear my market outtake, and there's a yes to that, so I'm gonna do it. I'm gonna give my market outtake. So there's gonna be a lot of factors, and it really starts with, I'm just gonna give this first disclosure before I really get into it. And that's that this is really just for educational purposes only. Invest at your own risk. I've kind of the point of this page is really to show you guys that you don't need to be an expert to beat the experts, but nobody can predict the market. It really is an impossible job to try to predict the future. There's too many variables in place. That's why 99% of investors can't beat the benchmark. The point of this is really just to look at the past, looking at X, Y, and Z and figuring out what that led to and figuring out how you can use that to better prepare yourself, rather than kind of just not knowing what to do, being like the deer in headlights, but having your financial literacy in check so that you understand how to deal with situations like this. We talked about how we've been in a bear market, so figuring out how you can deal with that, having that emergency fund saved up. So with this video, I'm going to start out by just talking about the month of July, where the market has been in the past month, where things are standing. Then I'll get more into my take on how I see things playing out, my predictions. But like I said, I'm not a financial expert by any means. This is just kind of how I see things playing out based off looking at a couple different data points. So I'll give my predictions, and then I'm going to give you a couple reasons why I think the market could go up, and then I'm going to tell you a couple reasons why I think the market could go down. Then I'm just going to leave off with a few takeaways. So let's get into this first slide here. Just giving the S&P market value. So June 30th to July 31st. So the month of July, we saw a pretty big increase from about 3,700 to 4,100. So July, the month was up 9.1%. So this was one of the greatest increases we've seen in almost 2 years. So this was pretty significant. But it really just does go to show that we don't want to time the market. We've been in this bear market where prices have been down 20% from the highs, and then we see this super month of growth of 9.1%, whereas if you were trying to time the market, you would have missed this time of growth. So you don't want to be timing the market, you just want to be consistently dollar cost averaging, and that's going to be a huge key takeaway here. So that's something that's really important for you guys today. So another point is, now that we're halfway through July, we're halfway through earnings season. And what does that mean? What have we seen in earnings season? We haven't seen good things. The earnings haven't been coming out that well. It's been the worst quarter of earnings growth since late 2020, so in about 2 years, worst quarter of growth. But this has been kind of anticipated as we've seen the market decline so significantly over the last couple months. We've seen that 20% decline from the highs. So it does make sense that the market has kind of gone up a little bit. But overall, we've kind of seen like a economy that's been overheated since COVID. We've seen a lot of tremendous growth. And as a result, the Fed has kind of increased heights, and they want to decrease spending as a result of this. So we've seen kind of these overheating in the market. So that's what we've seen. This is what we're dealing with currently. Now we're going into August, and there's kind of a lot of different predictions with how things could play out. Some people think, we've kind of hit that bottom and now we're going back up. And other people think we could be going back down to a bottom. So let's kind of get into it. So my predictions is that currently, we talked about what we're at, about 4,100. But in the short term, I think in the next month or so, I think we could continue to go up. I said we're halfway through earnings season, and although the earnings aren't coming out that great, the expectations aren't coming off too far off. So I think we could continue along that path where we see a little bit of growth over the next month or so, or we could see that S&P go from about 4,100 to 4,300. So it could climb another 100 or 200. But overall, in the next year or two, I do think, and I've kind of held this hypothesis for a while now, that the S&P is going to hit about 3,400, maybe 3,300. So that would be a pretty significant drop off. And even just a couple weeks ago, we saw the S&P at about 37 or 3,800. So this would be even a more significant drop off. We already said we're in a bear market where prices have gone down 20%. I really do think we could experience even more from that, maybe another 15% from that 20%. But overall, we'll kind of see how things play out, but I'll kind of get into why I'm thinking this, and why my argument is kind of why the short term can go up a little bit, but overall I think it's going to go down long term. And this is just a map of the S&P 500 over the last 5 years, so you can really see that tremendous growth over the last couple of years. So overall, you know, stocks, they're not really, you can see in 2020 where it really did go straight down, but it rebounded so fast. So stocks aren't really meant to go straight down, just like they're not meant to go straight up. You know, you can see there's always some fluctuation. It's always going back and forth. So, you know, when prices get too far from the average, that's when you kind of see all this crazy fluctuation. So we've kind of seen a lot of fluctuation recently. So we kind of always, just as an investor, we have to have that consistent mindset, stay stable, and not really be overwhelmed by moments like this. And just kind of understand over the long term, the S&P does continually go up. So having that long-term mindset is super important. But overall, the short term stocks, they're going up a little bit right now. So I think we could continue to see that theme. What's happening? Yields are moving lower right now, which often means that it gives stocks a little boost. It means investors are more optimistic on the yields, and investing in stocks kind of becomes more of an optimistic feeling. But this could go either way. But that is just what I've been seeing in the market headlines of what investors have been seeing in terms of the yields. They've been feeling more confident towards stocks as a result. And another thing that happened is we got the jobs report back on Thursday, and this came back really positive. It actually almost doubled expectations. So this was really positive feedback. And especially in a time like this where the market hates uncertainty, the market always hates uncertainty. That's where you can expect the most fluctuation. And we've seen kind of a lot of uncertainty over the last couple months, and that's kind of why we could have seen the bottom of this recession, or whatever you want to call it, because the market has already factored in so many of these uncertain factors that now we kind of can continue to go on. So a couple of those uncertain factors was like the Russia-Ukraine conflict, where all these emerging markets managers were getting killed. The China, they just started reopening, so this is positive look for investors. So based upon this news, a lot of kind of negative news has already been factored in, and investors are starting to feel a little bit more optimistic. So some investors have like this worst case outlook has already been behind us, and that's why we've kind of seen a lot of money inflow into the market in the last month. So that's kind of what we've been seeing, and I'm going to end on this, which I found really interesting, and it's really what we're seeing right now, which is why I kind of think that the market could continue to go up a little bit short term. And that's from a CFRA Chief Investment Strategist, Sam Stovall. He cites a clear precedent for the stock market for retracing from its losses, and specifically in each of the 20 years since World War II, in which a calendar year gain of 20% or more has happened in the market, which we saw in 2020. The next year, we've anticipated about 11% decline, and that decline tends to happen in the first quarter. So, and that really is what we saw the first quarter of this year. We saw the greatest declines, and then in July, we're already kind of seeing that rebound. So we saw, I think year to date, the market's been down 13%. So that kind of does go on track with that down 11% number. But it is pretty interesting to see that we did see that 20% gains, and now we're at that about that 11% drop. So we could be on our way back up. So that is why I am feeling somewhat optimistic about the market short term. But let's get into how I feel about the market kind of longer term, and I don't feel as optimistic about it. So overall, right now, we kind of talked about how we have a very hot labor market. The employment numbers came out twice as good as expected almost. So this would seem to be a really positive thing. But as a result, the Fed has to keep raising interest rates as a result to stem inflation. And this means that everything's going to start to get more expensive as you're making those payments. So it decreases the spending, which is what they want to do in a time like this. And it kind of goes along with what people have been expected. Goldman Sachs and Morgan Stanley just a week ago predicted this positive jobs outlook, and as a result, they heightened their risk of recession. And that's because there is such a strong correlation between when you have a low unemployment rate and then when you have such a high inflation rate. It tends to correlate with this recession, which is kind of what these analysts are seeing at these major banks. So it is important to kind of listen to what they're saying to kind of better help prepare yourself. And something else that we can now predict is that the Fed has been pretty open about raising the rates. The next time they'll meet us in September, and we're kind of already anticipating this 50% hike. So that will kind of already be anticipated in the market beforehand. But they did also say that they have a long way to go, so we can anticipate rates continuing to go up. And at a time like this, where inflation is already so high, people can barely afford to make their payments. I just think this is already adding to such a difficult time. So I really can't see the market going up with everything going on. There's so much inflation, the price at the pumps, which has gone down significantly in the last 2 weeks, which is awesome. But just groceries, going out to eat, everything is very expensive. So it's hard for me to imagine that the market just keeps to grow. So that was some of my reasons for just having a pessimistic outlook. But overall, there are a few more reasons that I want to get into. And continuing along this theme of looking at what are the major banks saying, Bank of America analysts pointed out that a surging labor market, which we're seeing right now, kind of mimics the lead up to the recessions in 2001 and 2008. So that kind of goes back to the strong correlation between this low unemployment rate and this high inflation rate, which is kind of weird because you would think the low unemployment rate would be really good. But when you have this crazy surge, it can be a bad thing. So it is pretty interesting that there are these kind of big bank analysts are already predicting these major recessions. The 2008 recession was a pretty hectic time, pretty crazy time. So for them to be saying something that significant is pretty noteworthy, at least in my opinion. So that is something that I've been paying attention to. And then next on the list, I have the Taiwan. And that's something that I've kind of been looking into for a couple of years now. Since 2020, I've always been saying, it's not a matter of if China takes Taiwan, but when China takes Taiwan. And it really is just a matter of philosophical differences. Going back to the time, China's always looked at Taiwan as theirs. And, their leadership, they can't be seen as weak. They're gonna take Taiwan at some point. And what does this mean for us? So many of our chips and all of our products, the electric cars, the iPhones that we use, computers, they all come from these chips, which are so reliant upon Taiwan. So I think when that happens, we can expect a lot of chaos in the market, especially when all these major brands that are in the S&P basically are pretty reliant upon Taiwan. So it kind of puts us right in China's position, which is something that is pretty scary. And just going along the lines of this, chief investment strategist of a $1.5 billion hedge fund says that investors should avoid chip makers in Taiwan given the current uncertainty. So, like I said, the market hates uncertainty, and that's really what we're seeing playing out in Taiwan. No one really knows what's going to happen. China's already employing military drills along the coast. So it will be interesting to see how this plays out, but I do think this will strongly impact the U.S. markets given our strong reliance upon China in a lot of ways. So this is something I'm kind of wary on, and kind of this is one of the main reasons why I am so pessimistic. So given that, let's get on to the next thing, and that's the Treasury yields. And that's what I have shown right here for you guys. And this is talking about the 2 and the 10-year Treasury yield. So what does that mean? That means when you're willing to get money from the government. So bond investors expect to be paid more for locking up money for a longer period of time. So when you have that 10-year period rather than the 2-year period, you expect the government to pay you more because they have that longer term outlook. They're more optimistic on the longer term. So as you can see, when the 2 and the 10-year yield has flipped, so when the government says we're willing to pay you more in the short term rather than the 10-year, so you can see that back here, and that has always pointed to previous recessions. So we have just witnessed that happen. So this is a strong indicator of a recession, and likely a pretty serious one. So that's something that's a major indicator to me that we're going to be in a recession and that we haven't seen the worst yet. So that's something that I'm really paying attention to. Maybe it'll continue to go back and forth, but we will see how that plays out. So next on the list is insider selling, and this is something that's really important to pay attention to. So this is the CEOs of the company, the chief operating officer, the people that are on the board of these major public companies. You can see whether they're buying and selling their own shares of the company. And this is interesting to see how they're feeling on the outlook, because they really have that insider's view. That's why it's called insider selling. So seeing how they feel about the market outlook. And as of April 21st, April 21st of 2021, out of it took 143 sales to every buy of these insiders. So that means these people are selling like crazy. So that means they don't have a very positive outlook on the market. So that's something that I think is very important. So if these people that are working at their companies, they're selling the stock, there are other factors that could be in play, but when it's this significant, I really do think it is just a matter of them feeling very negative on the market outlook despite these significant gains. Or it could also be along the lines of trying to buy, selling high and buy low. So we'll see kind of how that plays out. And then lastly, I just wanted to say the Inflation Reduction Act, which was just passed. I was just doing a kind of brief dive at it, and there's so many taxes involved. So that's really just gonna hurt the middle class and the lower class especially, that are already hurting so much right now. So it's going to continue to lower the spending, and when the spending is lowered, people aren't spending money at these businesses. So I just don't think the stock market can continue to grow at this pace, despite the month of July. I think August we will continue to see some growth, but long term, I think 3,400, 3,300, that's where I'm going to start to feel very optimistic about the market. But overall, be continuing to dollar cost average, continuing to invest on a weekly, monthly basis, whatever it is that you decide to invest, continuing to invest automatically, not changing up those theses. But when you hit these bear markets, I think it's a good opportunity to invest more aggressively and just invest just maybe $20 more, because that can definitely go a long way. But overall, we've seen kind of a lot of printing of money, inflation, the debt, and that kind of goes to this Inflation Reduction Act. It's just going to increase the debt, which I made a video about previously, how America is kind of in a debt crisis at this point, whereas other countries can kind of catch up to us as being the reserve currency, which would really be a crazy global situation. So I just think there's a lot of also global uncertainty as well as domestic uncertainty. So that plays into kind of this market uncertainty, which the market never likes. So I don't see a lot of positive factors going in there. And overall, just one thing that I think is really important is just when you drive around, when you go to the restaurants, everywhere I see has help wanted signs. So when you see the small business owners and they can't really afford to hire these employees or can't find the workers, I just think that gives me a very pessimistic feeling on the market and how I'm feeling about things. So overall, I expect the S&P to maybe hit 4,300 in the short term. So short term, a little bit of growth, but in the long term, and although I'm saying long term, this isn't long term by any means, but in the next year or two, I could expect to see the S&P to hit 3,400, 3,300. So overall, the goal of this page is to help you guys be actionable. So what can you guys do? That really just come down to being diversified. You know, in times like this, growth stocks aren't going to be the best despite them being awesome over the last couple of years. So being invested in value stocks, being invested in companies that are paying you dividends, which I like to call free money. So investing in not only America also, but being invested in international stocks. And you can do this all through index funds as well. So I think that's kind of everything I wanted to talk to you guys about today. Really long video. If you made it to the end, you know, just continue the dollar cost average, continue to automatically invest and not think about it. Don't get involved in the emotions of the short term, the highs and the lows in the market, but just continuing to be a long-term investor so that you can generate that financial freedom and live the life that you want and not being hostage to your 9 to 5 your whole life. So thank you everyone for tuning in. JD Strategic out. I really hope you found this video helpful. Really hope you found this video helpful. If you want, I can continue to give more market outlooks. But thank you so much. Happy Monday. JD Strategic out officially.